let's talk about markets and hedging stocks with futures, something that you and I talk about pretty much every month or so, but it's because it's so important. And we're still kind of on the forefront of people just starting to realize how easy it is to hedge and how easy it is to spread and pairs trade. It's a common theme for us, Katie.
It is. And not only that, but I think it's a really timely conversation right now. A lot of people towards the end of the year, they get bonuses. They have opportunities to do a little bit more with their 401k. You tend to see a lot more accounts opened in January when it comes to trading and participating in markets. So maybe for some of the newbies out there who are thinking of finally opening an account or who are going to watch this in the future as an archive, maybe we can give them a little bit of a how-to, because as you know, stocks are a lot more approachable to the person on the street than futures are, but this is a really great way to start to integrate and cut some of that risk that goes along with just the static delta of like a long stock position or a short stock position.
Absolutely right. And before we get into it here, we're going to go A to Z on hedging your stocks, but then also land in the world of pairs trading and spread trading. This was an idea from viewer Hugh. Thanks so much for reaching out. And everybody else should feel empowered to reach out to frank@tastytrade.com or Frank_Caberna on Twitter. That's Caberna with a K. Any ideas like this, I'll either answer it straight away or we'll do a whole segment on here and I'll waste 30 minutes of Katie's time asking her about text art and Ariana Grande, and then we'll get into what you actually ask about. But please feel free to always hit us up, and Katie McGarrigle on Twitter. She's much more prolific and funny than I am with all of this stuff. But let's get into, because futures were by and large created for what we're talking about. They were created over 100 years ago for different producers of assets like rice and corn and agricultural products to hedge what they had. And right, here in 2020, or sorry, go ahead.
No, I was just going to say like their crop or their output of whatever that was.
Exactly. Like that was what they had back then. Now in 2021, we have text art and NFTs, and we need to hedge those assets here with futures. And that's why stock futures are so prominent here. You use futures in this case as a low cost way to take some money off the table. And this is particularly apt during low volatility times like we're seeing right now. Because what happens in low volatility, Katie? Well, volatility is often low because stocks are doing well and there's not a lot of fear in the market. And so when volatility is low, options are cheap. And so selling calls as a hedge, not as attractive. Going to futures to kind of take, like I say, take some money off the table, so to speak, in a low volatility environment is as good a time as any, right?
Yeah, exactly. I mean, as you mentioned, volatility can signal opportunity, but the opportunity well isn't completely dry, for lack of a better metaphor. You can still utilize these other products or these other strategies in times when low volatility is around, like now.
And what we have in front of us here is the newsletter, the small exchange newsletter to all of our community members. If you're not already, definitely go join us. We've got a lot of cool stuff going on, low fees and this newsletter. And I'm actually currently putting in an order for a bunch of new shirts for our community members here, community.thesmallexchange.com. And what we have is a ton of data in front of you, and it looks scary. And it's essentially like a little less scary of an Excel sheet, but we're going to make you feel a lot more comfortable here than you would maybe in Excel or otherwise. As I highlight this section of the newsletter here that is pertinent to hedging, the idea here is really simple. Like, I know it seems big, like, oh, managing risk or hedging with futures. Those are big, lofty ideas. It really comes down to like, how many shares of stock do you have? Or how much money do you have invested in the stock market? Okay, that's one number that you need. If you don't have that number, I don't know what to do for you. This is going to be a tough. If you don't know how much money you have invested in stocks, then you're going to have a hard time hedging it. But you find that number, Katie, and then you decide on how much you want to hedge as a percentage of that number. Maybe I want to hedge 10%. I want most of this on, but I want to take a little off here. Maybe I want to hedge 50% because I'm feeling really, fearful, or stocks have been really good to me in the last couple of months and I want to take a lot of it off the table. You decide on that percentage, and then all you do is you use the small exchange futures. Because they are so small, they give you great flexibility to decide on how many of them you need to sell against your equity position. Am I making any sense?
Absolutely. And I also love too that, you've given the people here with this newsletter a couple of different options when it comes to determining what exactly they're exposed to. Because, let's face it, a lot of people out there just trade what they know or what they like or what they dislike. So there's a couple of tools that are already built into the technology, whether it be like beta weighting your deltas or things like that, where you're actually balancing it to one of these benchmarks, particularly SPY, and you can still utilize that information to hedge with futures, even if you are just trading Apple or just trading Amazon or, any other name out there.
I'm so glad you said that, because it is imperfect. A lot of people get caught up and which isn't necessarily a fool's errand, but it's halfway to a fool's errand, I think, which is like the correlation has to be exactly right. And I need to know exactly how many shares I have of Apple and what's the correlation between Apple and the S&P 500? Oh, well, it's only 0.9 and I've got 300 shares of Apple. And so that only gets me X shares. Everybody. Yeah. All of that stuff is really interesting and it's important to a degree. But as someone who has been, trading for 6-7 years now, used to do so professionally, and my job was literally lining up these different markets. I had hundreds of spread markets in front of me with all varying correlations and all this different stuff, trading professionally at the Board of Trade. The numbers at some point don't matter that much. Okay. Yeah. If you're trading Apple, Amazon, even like semiconductors or energy stocks, all of this different stuff, you can feel pretty confident that as long as I can translate it to the S&P 500 or shares of SPY, or like Katie says, beta weighted deltas of SPY, then I can feel pretty good about going to almost any equity index future for the hedge, right?
Yes, absolutely. You nailed it.
Awesome. So let's get into the thick of what happens when you put that percentage, that hedge percentage, at 100%. Because what we've talked about to this point, Katie, is just simply like, I've got a bunch of money sitting in SPY shares or Apple shares or any stock share. And given that the market is back at all-time highs and volatility is low, I want to take some of that risk off the table. And so you can go to, your small stocks futures, or your small technology futures here. And just for an example, actually, before we get to the second half of this segment here, say you have, $50,000 invested in just a plethora of stocks, and you want to hedge, 10% or 20% of it. Let's make it a nice, easy number there, 20%. So I need to hedge via this math here, $10,000. And considering that the small exchange futures, the equity futures range from like 5,000 to 10,000, that means I just need to sell one or two of the small equity futures. And then I've got my hedge. Now I'm hedged 20% of my stock portfolio. If stocks then move lower from these highs, I can buy those futures back. And then I'm back at 100% investment and I've made money on that hedge. That's the whole point here. And I think that example rings true, unless did I confuse anyone with that one, or does that make sense before we get on to what I know you're excited about, which is pairs trading?
No, I think you nailed it. It was a hard thing for me to wrap my head around as a beginner. And I think like one way that helped me describe it was kind of like, if you're learning how to ride a bike, and maybe you've never experienced riding a bike before, like you want to have those training wheels on, and the futures can kind of be like those training wheels in the sense that like they're not fully on the ground, but you know how on like certain bikes you can like raise them up, so like you can still get used to like the balancing. That's like, I don't know. I know that's like a stupid example, but like you nailed it. I'm rambling at this point. Let's keep going.
Yeah, I like it because like it's essentially like you're riding two wheels and fast when you've got
Yeah.
no hedges on, like, and which is like great. Like I can speed, I can really bullet down this hill on my bike here. I can make a ton of money on my investment, or I can throw on, a little training wheels, or I could throw on really aggressive training wheels and hedge, like I say, 50, 60, 70%. Most people don't hedge that much of their portfolio unless they really are fearful of something happening. And futures really let you do that for low cost. And just to further the example, say you got 50 grand, you want to hedge 10 grand of it, selling a small exchange future to hedge 10 grand worth of stock, Katie, is going to only cost you a couple $100, which is really nice because the alternative is to go in there and sell your shares of stock and then buy them back again at a later date. No one wants to uproot your investment. Just keep your investment going, whether it's in your 401k or in, an IRA or wherever it is, and go to the quick and easy futures. You sell the futures at the highs to hedge your stock. You buy it back when it's moved lower, and it's never been cheaper or more flexible with the small exchange futures. But what happens if you hedge 100% of the stock position, Katie? Now you've created a whole new strategy that can profit from bullishness or bearishness, right?
Too true. Too true.
Too true. My friend Katie says, yeah,
true.
This is what's really. Was that
two
a two? Now you're okay. There it is. But what's really nice about this is it's the same idea of like hedging, right? But it's just once you take it to 100% and you hedge the complete other side of that stock position, now you've got something that's just a whole new trade. And I put the arrow here on our small stocks versus the small technology futures, and they trade, thankfully, just around 1-to-1. And what you'll see now is something that is altogether different than having a long or short stock position. Katie, you've got a pairs trade that can profit from when stocks go up or stocks go down. I know you've traded this one before, the SM75 versus sticks.
Yes, absolutely. And I love too, like even looking at that matrix that you just showed. I mean, we talked a lot earlier in the segment about calculations and figuring out, okay, one small is equal to, 20 shares of SPY. But on this matrix, you can see that you've already given them the ratio, which is super nice if you're trading on the fly, if you don't have a ton of time, or if you're like, oh man, it is low volatility. I do want to kind of make an assumption on this relationship between these two different indices and just like move on with your day. It's nice to just have that reference right there for you.
Yeah, I stole this idea from the nerds at the prop shop that I traded at the Board of Trade, where it was just like I said, we had a bunch of spread, like literally hundreds of spreads that I was supposed to be trading and looking at throughout the Asian and European session. And there was just one Excel sheet that was all of the ratios. And so if you saw an opportunity somewhere, you just went straight there. Oh, it's 3-to-1. Perfect. Thankfully, most of the small exchange products, we designed them to be similar in size and volatility. So they're almost all kind of 1-to-1 or 2-to-1. Actually, Katie, you'll love this. Yesterday with Pete Molmat, I put on the 10 fly, the 10-year Treasury butterfly, which is 3 markets against each other. And I used to have to do that with the CME products on like a 10-to-7-to-3 ratio, which is absolutely nuts. Thankfully, you look at this stock, this kind of simpler version of that equity spread trade, which is just like the stock market against technology stocks. In particular, it's 1-to-1, and you can see that it's actually back at a high. This is one that I don't mind taking a look at today, right after we wrap this up. Maybe we'll open the platform and show you. I can put it on. But what's really nice about this, Katie, simple ratios that we have there for our community members from the small exchange. And also a new strategy that when you take that idea of hedging to 100% can profit from the stock market moving lower or moving higher. Because our viewer Hugh, Katie, asked, well, like, why don't I just buy both the markets? I just buy both of them. And it's like, yeah, you can buy both the markets and just be really long stocks, but you're just long stocks. That's not a new strategy here. When you sell the SM75 and buy technology, stocks in the next 24 hours, the next week could go down a lot, could go up a lot. And this pairs trade is just the difference between the two of them. It can profit in either direction.
Exactly. Yeah. And that was going to be my question to you. Walk us through what is on this Y axis, this 250, 500, 750. How are you how are you determining this visual, I guess? Is this like one divided by the other, one subtracted from the other?
I'm a big proponent of looking at spread markets, one subtracted from the other, especially with small exchange products. They're almost all 100 times the price, just like trading 100 shares of stock. And so if SM75 is at $80 and STIX, the small technology future, is at $65, then the difference between them is $15 or $1,500, which you can see there on the Y axis. And what's interesting about this graphic in particular is you can see that we designed these products to be the same size. We wanted them to have a difference of 0. And we knew, of course, they're different equity indexes, so they're going to move around. But that kind of shows you the opportunity for you. When it's really high in the positive, it's up to $15, $16 worth of difference. That means that, one is greatly outperforming the other. So the Y-axis is the notional difference, but it's really easy to calculate, really easy to think about, especially considering that we created these products trying to make them kind of level in mind. And as I bring up the platform here, you can see with the fantastic Tastyworks Pairs Trader just how easy it is to visualize some of this stuff. Pete and I were looking at a long Bitcoin short NASDAQ trade yesterday, but in this instance, we would be getting long the STIX futures and short the SM75. Let's see. Yeah, that spread
and that's
is
due to the fact that it is at that 1,500 price extreme, and this setup would give you that convergence back towards, let's just call it 0.
Exactly right. And actually, we're in the midst of what looks like another low or actually high, depending on, you can see that this is what that chart was showing you. And so that's why it looks like a high when I'm looking at SM75 versus STIX. Getting on the other side of it is something that Katie and I are usually interested in as kind of contrarian traders, people who go against the trend. And so I would look at buying the STIX, selling the SM75. You can see the spread today is out, STIX being down 30 cents, SM75 being up about a dime. That's a difference today of about 40 cents or $40, pretty easy to understand. And you can see that this number, $1,900, is directly reflective of the graphic that we just showed you, right? It's up actually past these highs when I created this graphic. And so you're at the moment actually getting the biggest price extreme in this spread.
Yeah, exactly.
Very cool stuff,
and
Katie.
here you can just lock it in like right here on the pairs trading platform. So it's a nice way to kind of not have to do one piece at a time. I think that was also like a big concern for somebody that was new to pairs trading is what leg do I put on first? This is at least an easier way to kind of enter that position. And then from here, you can constantly refer back to this piece of technology and see, okay, where you are. If I got filled at negative 1,900, am I profiting or losing, when I look at this, of course, on your positions tab as well, but a nice visual if you are that type of person.
A lot of different ways to look at this. Yeah, you can, in my mind, I'm buying negative 1900s. And so I can pull the pairs trader back up, this same exact setup. And if it's up to negative 1850, I made $50. If it's up to negative 1800, I made $100. And that's probably what I'd be looking to take 100 or maybe even 200, considering the extreme here on this pairs trade in the next probably take a couple of days to weeks. And you can also visualize that in your positions tab, like Katie said, just see what the P&L is of the one and then subtract the P&L of the other from your position. And you can, you just add the P&Ls together and there you go. You got it. But that is our time here for Small Stakes today, Katie. Thank you so much for joining us every Wednesday. Katie McGarrigle, you can catch her on Small Stakes. You can catch her on Twitter, and you cannot catch her in the TechStart store. She's not buying that TechStart.
I was just going to say, I know what I'm going to get you for a late Christmas present. I'm going to get you a TechStart NFT now. So
even that's, I love that idea. And yeah, in like 10, 20 years from now, I'm going to be going to like a dinner party at a friend's house and they're going to have just a flat screen with their NFT text art.
Yeah, with like live, laugh, love.
Oh, brutal stuff. Hey, but let me reiterate, if you like text art, that is totally cool. Anyways, I'm going to bring on our coolest mutual friend, Pete Momat. Splash into Futures is coming up next, everybody. Hang around for that. And thanks for watching Small Stakes. Peace.